think 30, right in the 3,200-ish range. 3,200 would be that support level. And the greater the volatility, typically it precedes some sort of a major move higher. So this to me is all par for the course.
Gold stocks got hit. Gold was down 2% on the week. It closed at, let's see, 3,240. I think something like that. Let me take a look. Yeah, 3,241.60. And, I heard a lot of talk. That's it. The bull market's over. Blow off top, right? Finally, it's over, right? It was too speculative. There was no speculation there. Yes, it got a little hot for a few days, and now it's come down.
If the stock market goes down, gold and silver go down. Okay, well, if you look at what's happened over the last couple months, it's been totally opposite to that.
Gold hit $3,500 an ounce. Then the selling started. In this week's recap, we dive into what's really going on, with insights from three of the sharpest minds in finance: Andy Schectman, Peter Schiff, and Michael Oliver. China is reportedly offloading gold, and both retail investors and smart money are rushing for the exits. But is this a panic-driven mistake? We watched hours of footage, so you don't have to. These are the best clips of the week, so we keep you informed. If you value real insight over hype, make sure to subscribe, turn on notifications, and share this with a fellow gold bug. Let's get back into the episode. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
It's way above the prior resistance. So it's a massive breakout of the price of gold. And it wasn't a bunch of speculators that were buying gold. In fact, the public was selling gold stocks all month, even during the rally. You were getting net outflows out of GDX and GDXJ. And they certainly weren't buying physical gold. I mean, the phones weren't ringing off the hook at Schiff Gold. I mean, it picked up a little bit, but really not much, because the public is mainly selling their gold. We have a lot of people, I've talked to other gold companies, people have been calling up to sell their gold because they need the money. And now they can get, a higher price. And so they're making a mistake. They should keep their gold, sell something else, because gold's going to go up. But it wasn't a bunch of speculation. But, this was a risk on week. People were thinking, aha, the worst is behind us. It's not going to be as bad as we thought. Yeah, I'm going to buy some risk assets and I don't need a safe haven. And so you got selling in gold. You got buying in tech stocks. You also got buying in Bitcoin, right? Bitcoin was up about 2.5% on the week too, in line with the NASDAQ. And, just before this week, I was hearing a lot of the Bitcoin guys, because Bitcoin didn't get clobbered when NASDAQ, had its final leg down, because it kind of led the decline and then kind of bottomed out. And then the NASDAQ kept falling and Bitcoin went sideways. And everybody was saying, aha, you see, Bitcoin is finally decoupled from the NASDAQ. It's no longer just a proxy for tech. It's not a risk on. It's more like gold. It's more risk off. It's more a safe haven. And of course, none of that was true, because Bitcoin traded nothing like gold this week. It traded the opposite of gold, and it traded in lockstep with the NASDAQ. So that's really what it is, right? Bitcoin is like the NASDAQ, except why buy Bitcoin? Just buy tech stocks, right? If you want to buy a safe haven, if you're worried about inflation and dollar depreciation, then you buy gold. If you want to speculate on the direction of the NASDAQ, just buy tech stocks. That's better than buying Bitcoin, because eventually Bitcoin is going to decouple from everything and just go straight down. So, eventually tech stocks will go up and Bitcoin will go down, right? So you're better off, if you want to speculate on tech, don't do it through Bitcoin. Just buy the tech.
Now, Andy Schectman shares his price predictions for gold and silver and shares his insights into what's next to come in the precious metals markets after some major news from China hit the tape.
I think that from here on out, you're going to see more turbulence, more volatility, sharper swings, but nothing's really changed. In fact, I just think you have to not get shaken out. The bull wants to take as few people along for the ride as possible, and you have to keep your perspective. Um, they try and tell us that this was the Chinese dumping like 1 million ounces of gold. Let's just put that in perspective. So, first of all, when we talk about Chinese gold-backed ETFs, in the month of April, they saw more inflows than all of 2024. And that's just in the first 11 days of the month. And when we talk about China dumping gold, first of all, their markets are closed right now until May 5th, which is very peculiar. In fact, this lends itself to making you think of conspiracy and of manipulation and of suppression during Chinese trading hours when their markets are closed. That's a clever trick. To me, that's very suspicious to say the least. And Goldman Sachs' story is very suspicious. And I think the bullion banks were able to exploit the closures in the Chinese markets to smash the price. If you look at a chart, a continuous 24-hour chart, you see it go up every time it hits Chinese trading. It goes up and gets smashed as it comes into New York. Well, with all of the Chinese markets being closed until May 5th, suspicious. Goldman talked about a 31-ton dump, but they didn't make any delineation between the Shanghai Gold Exchange and the Shanghai Futures Exchange. So I did a little digging. The Shanghai Gold Exchange delivers less than 4 tons a day, right? And so, in essence, the majority, if not all, of this dumping was done in the futures market. And so I think that's important here. You're not seeing physical gold being sold off. You're seeing futures being sold, and it's done for effect for sure. Let's talk about what's happening here in the United States. We saw for the May contract in gold, 9,306 contracts stand for delivery. That's the second highest ever for a non-active delivery month. The silver May contract, 14,813 contracts stood for delivery. That's the second highest ever, just behind March's record delivery. And we're beginning to see these short positions that are closing their positions, and you knock it down, and a good way to close it. But it seems everything's settling for physical delivery. The other side of the short, the long says, great, we'll stand for delivery, please. Who are those longs? We don't really know. But to me, this just exemplifies continued demand at the highest level. So I think people need to put things into perspective. It's been quite a run in gold. Silver hasn't even begun to blow out from its technical formation. I suspect it will, and probably much more so than what we witnessed in gold. But I would just simply say that it's going to be bumpy, but nothing has changed, not even a little bit. And with the Fed meetings and all the things that are happening, I think perception, this was a perfect opportunity for, if I had to guess, the Western bullion banks to knock the hell out of the price, say it's the Chinese, even though their markets are closed, and do what they can to close out their short positions, or to settle things with metal that they're able to then physically buy on the cheap. So this doesn't bother me at all. It nothing goes straight up. It's certainly violent, but also put it in perspective. A $60 or $70 drop is 2%. So it's not a massive drop. The dollar numbers are higher than most us gold bugs really think about, because it hasn't been at these levels for very long. And when you're at 3,000 plus gold, a $300 move, well, it's still 10%, but it's a big one. But when you see $60 or $90 move, which really freaks people out, you're talking under 3%. So, you're going to see paper market volatility. That's just the bottom line. You're going to see that the higher the price goes. But I still think gold and silver will climb the wall of worry that everyone is freaking out about on social media right now.
In today's news recap, Chinese investors slash gold futures positions by 1 million ounces. Key trading insights as gold prices surpass $3,500. According to the KOBEC letter, Chinese investors reduced gold futures positions by approximately 1 million ounces on Wednesday night, marking the third largest reduction on record. This follows a significant buildup of 1.2 million ounces on April 22nd, highlighting sharp shifts in trading sentiment. The adjustment coincided with gold prices briefly exceeding $3,500 for the first time, suggesting a potential profit-taking phase or risk management strategy among large-scale traders. Such large moves in gold derivatives may lead to increased market volatility and influence short-term price trends. Traders should closely monitor open interest and volume changes for potential breakout or retracement signals. The cryptocurrency market has been buzzing with indirect implications following a significant move by Chinese investors in the gold futures market. On Wednesday night, May 1st, 2025, Chinese investors reduced their gold futures positions by nearly 1 million ounces, marking the third highest reduction on record. This dramatic unwind comes just weeks after these investors added a record 1.2 million ounces to their positions on April 22nd, pushing gold prices to briefly surpass the $3,500 mark for the first time in history. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
Prior to this, over the last year, for example, if you'll look at what gold did, it moved up in layers and sometimes would be stuck in a horizontal zone for a handful of months. Go back to April of 24, for example. We said in March of 24, expect the beginning of the bull market again. In other words, it's been asleep for 3 years. And it's sure enough, it engaged, but it still had these layered, time-consuming zones of nothing. Where we just simply hold and absorb the selling and finally can go up again. Well, right now we're in the second week of a pullback period. So in fact, it's not even a full 2 weeks because, anyway, the number of days is a handful. And I suspect this will be brief. It won't be multi-month. I don't think we're going to correct like everybody seems to think. We're going down to 2,800. I think what people are doing, our price chart is primarily, is when they project, it's all over for now, we got to go back down to here. Every time they do that, what they're doing is they're finding the prior shelf of highs that was broken through, and then you get a surge, and they seem to insist that you must go back to that prior high to test the price high. And gold hasn't done that. Instead, it's pulled back, but never gone back to the prior high. And right now, the assumption is, we're going to have to drop $500 from the high to get down to 2,800. And, it's going to take a long time, et cetera, et cetera. And this derails people emotionally and a lot of them get out of their positions. And we made a point of that in the last weekend report. We showed, I think it was 2010-11 phase in the gold bull market then, where we were in the acceleration phase. And we circled all the times where you had these scary downside breaks and or congestion zones. And we posed the question at each of the breaks. We said, you got out, but did you get back in? Because usually, boom, if you weren't really precise, if you got out, you didn't get back in, unless it made a new high again, in which case you missed a chunk. You get the point. I think that's where we are. Silver's the wild child. When gold had a mild little pullback during that stock market break in the first week of April, silver had a huge break. It went from $35 to $27.5, much of that occurring in 2.5 trading days. And so if you look at a silver price chart, you wiped out the prior major low in December, which had halted. It had dropped from 35 down to just above 30, and went back up to 35 by March of this year, and then puked through that low like it was the end of the world. And in a heartbeat, it went from 27.50 up to like 30 and a half, 31, 32, 33, and right now we're trading in the 32s. I suspect this sell-off doesn't have much more time in days and or price, and that we can see when we look at momentum, whether we're looking at real short-term silver gold momentum like day-to-day type momentum action, or looking at some bigger pictures, it looks like it's a setup for another surge. In other words, we're just having another pullback. And I don't think silver is going to have another puke. You don't generally have two of them. In other words, if you had one that washed everything out and immediately slingshotted back up into normalcy, you don't do it again. You've had your cleansing. So any people expecting a duplicate cleansing, I think they're wasting their time. Anyway, that's where I think we are.
What do you think of Michael's take? Do you agree with his call that a breakout in precious metals is not just likely, but inevitable? Is the S&P living on borrowed time? Let me know what you think in the comments below. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.